Hello student, this is Đức here. I understand that today in week 5 lecture on Wednesday there is a technical disruption, so Nava could not finish her lecture. So I'm doing this video to cover the remaining part. Understand that Nava has stopped at the ratio analysis, right? So in summary, the ratio analysis is performed as part of the preliminary analytical procedure, where the auditor will undertake their analysis to gain some understanding on the financial statement, right? So ratio analysis is performing at the planning stage at the beginning, before they conduct their field work, right? The auditor will perform ratio analysis by calculating some basics financial ratio on the unaudited financial statement. All right, I emphasize this is the unaudited. So it is basically is the report that have been prepared by the client. Whether it is correct or not, the auditor doesn't haven't done the testing, so they just do the quick ratio analysis to understand the requirement. So this ratio can be compared to two things. First, the industry data. So if the auditor, based on their understanding of the client, they may be able to develop an industry benchmark. It can be by their search on the internet, by their own research based on some of the industry magazine, or it may be on the average ratios for each of the particular industry listed on the Australian Stock Exchange or any other media channels, right? Second, this ratio may be compared with the internal data from the client. For example, it can be compared with the previous years, the same ratio that in the previous year. It can be compared with the budgeted or the forecasted figures. It can be compared between the segment or between department, what we call in segment or division data, right? So some of the common ratios that normally be performed by the auditor include number one, short-term liquidity. So short-term liquidity ratio is including three type ratio: quick current ratio, quick assets ratio, operating cash flow ratio. So each of the ratio have its own meanings, and if the current ratio is measured the company's, the client ability to pay their current liabilities by using their current assets. Quick assets ratio assets test ratio is in the same meaning, but it's based on normally the current assets is only included, like cash or some other current assets, but very quickly to convert to cash, right? Like foreign currency or so. So of course, it does not include the inventory and account receivable sometimes, right? So quick assets ratio normally is just including cash or something similar, easily converted to cash, all right, divided by current liabilities. It measures how quickly the client can, pay off their current liability. So the benchmark will be current ratio and quick assets ratio is higher than 1. That means they have more assets to pay the debt, right? Operating cash flow ratio is measure the cash flow from the operation from where to the current liabilities, right? There are the two common activities ratio that the auditor normally use is the receivable turnovers. That is, the turnover, the circle, how many times, right, they can collect the receivable, days in receivable. So average circle, receivable circle. So that means, in 1 year, how many days the client can collect on the account receivable, right? There is another common ratio, that's the inventory turnover or days in inventory. All right, so the formula is in the slide. I'm going to explain in the next example later, but let's just quickly go through the theory one, right? So in profit, the auditor also calculate the profitability ratio. Normally they calculate the gross profit or net profit ratio, return on total assets, return on shareholder equities. So gross profit will be, say, okay, if there is $1 of revenue, how many cents that they can generate as a gross profit or the net profit. All right, so normally that is the percentage on the net sale. Return on total assets, this means for every dollar of total assets, how much the company have generate a return or a profit. Return on shareholders equity is similar. For every dollar of the shareholders, for every dollar that the shareholders or the owner has contributed, what will be their return? How many cents is their return, right? The last, the fourth common ratio is about solvency. That is measured by the debt to equity ratio and times interest earned, right? Debt to equity ratio means what is the percentage of the debt or the liabilities over the shareholders' equity, right? If for the company, if normally the benchmark be with 1, so or will be lower than 1, so that means the debt is lower than the debt is lower than the capital. If the debt to equity ratio is quite high, that means probably the company is have to rely a lot on their debt to operate the company. So there is the risk of, they have to pay a lot of interest, and there is the risk of solvency as well, right? That means their own capital is not cannot cover their debt, right? Times interest earns is measured, right? How many times that the net profit that they have generated before interest and tax that is higher than the annual interest expense. Right, so the higher the better for this one, right? So let's look at one of example 5.8 here, right? So we see this on your screen, that is the figures of the sale. So as we can see, actually sale is remaining the same between 3 years, right? There is a slightly movement of cost of goods sold in year 2002, which is cost of goods sold is a bit lower. 2 million lower because the cost of goods so lower, so that means actually it generated higher gross profit in year 2002, right? And that come up to the net profit is also higher because we assume that all other expense are equally the same between the 3 years, right? So so that is one of the example of the common size statement, right? Okay, the next one that we have is the trend statement, right? So the trend statement is each item is expressed as the percentage of its own level from the base year, so that it will focus on the trend rather than the absolute figures. So with the same example before, right? So we convert the common size statement into the trend statement. So in another language, common size statement is similar to the normal statement that you see often, and the trend statement is just about the trend, the percentage, right? So we see that, for example, in this example, then how do you interpret? Okay, so sales has been increased by 20% in year 2002 compared with year 2001, and year 2003 is a significant increase of 250%. All right, so in line with the cost of goods sold, so as you can see on this baseline here, year 2001 is actually on 100% because that is one, is the year one, yeah, and then it's year two, that is in year two the cost of goods sold has been increased by 16%, in year three increased by 250%. Right, okay, so this trend statement shows that the net profit is up by 28%, or is up by $2 million, right? 27 million compared with 25 million in the previous year, and 60% for the 2 years, from year 2001 to 2003. And it's also show that the operating administration expense are increasingly at a much faster rate than the sales or the cost of goods sold. This may not have been easy to observe with other analytical procedure, right? So the trend, so based on the common size statement where you get the base statement on the figure here as 100% as one, and then you compare this amount with this amount, yeah? You compare the year 2002 and year 2003 figure as the percentage of year 2001 figure, right? Okay, now, so yes, and auditor need to use analytical procedure, right? But the most important is they have to check that, where the reliability of the data, right? So whether data is shot from outside the entity or inside. Outside is always more reliable than the internal data. Whether this is data is coming from an effective internal control system. If the companies have a good internal control system, that means data is more reliable. Data from the audited last financial year is more important, that is more reliable than the unaudited data, right? Okay, so beside that, the auditor also based on the forecast, the budget, so and then checking on the precision, the accuracies of the data, right? So in doing so, they have to compare with a different source of data. For example, here it can be, compare with the environment. If the environment is stable, the data will be more reliable, right? And then the auditor have to look at the fluctuation, whether the fluctuation are significant. If this fluctuation is significant compared with the budgeted, the forecast, or the previous, it indicates that, this is the area that the auditor need to investigate more, right? All right, there is another form of analysis, that's the cash flow analysis. There are three components of cash flow: cash from operation, cash from investing activity, cash from financing activity. So the auditor will perform the cash flow analysis to see whether the company has generated a positive cash flow. A positive cash flow means the cash inflow is higher than the cash outflow. The cash received is higher than the cash has been spent, right? So in summary, before accepting an engagement, auditor need to determine that, they can complete the engagement in accordance with Australian auditing standard, and they have to comply with the professional ethics, right? They need to, if this is the first year engagement, they need to contact the previous auditor and to see, what was the reason why the auditor has been changed, or evaluate the management integrity. They need to issue the engagement letter and then perform the audit plannings. An audit plan or audit program should be developed to reflect the strategy, the schedule, and the staff. So that is all for chapter 5. I hope it is helpful. If you have any question, please let me or Nava know. Thank you.